Before we dive in, just a quick reminder. This content is for educational and informational purposes only. It is absolutely not financial advice, so please always do your own research. All right, welcome back to our deep dive on DEXI bonds. In part 1, we learned what a bond is. Today, in part 2, we're going to tackle the big one. Why does its value change? And we're going to do it with one simple, powerful idea, the Seesaw Effect. Okay, let's get right into it. But before we solve today's big mystery, let's do a super quick recap of where we left off in part 1. We established that a bond is kind of like a toll booth, right? It just sits there collecting fees from every trade that goes through it. And we learned that the bond ratio is that key number that tells you exactly how much ETH your bond is actually worth. But that left us with a huge question mark. We've all seen the bond ratio go down over time. Why? I mean, what force is actually pushing it down? Well, that is the exact question we are going to answer right now. To find our answer, we have to look under the hood of the bond and into the engine that makes the whole thing run, the liquidity pool. So every single liquidity pool is, at its core, just a pair of two different assets. On one side, you've pretty much always got a major asset like ETH, and on the other side, you have a different token, which we'll just call the altcoin to keep things simple. And you see this exact structure all over the DexFi ecosystem, right? You've got pairs like ETH and RAI, ETH and ETL, and so on. It's always this dance between two tokens. Now here's where it gets really, really interesting. Every single pool lives by one single critical rule. It has to, at all times, keep the dollar value on both sides of that pair perfectly balanced. And this one rule, this is what creates the entire effect we're about to explore. So, how in the world does it maintain that perfect balance? Well, this brings us to the heart of today's explainer, the Seesaw Analogy. I want you to literally picture a playground seesaw. Got it? On one seat, we've put all of the ETH in the pool. On the other seat, we've got all of the altcoins. When the value is equal on both sides, the seesaw is perfectly level, perfectly balanced. This is the pool's happy place. But what happens if the price of that altcoin suddenly tanks, let's say by 50%? Well, now the value on that side of the seesaw is much, much lower. That side gets lighter and whoosh, it shoots up into the air, while the heavier ETH side comes crashing down. The seesaw is now dangerously unbalanced. A liquidity pool cannot allow this. It has an automatic, built-in reflex to fix it. To rebalance the seesaw, it has to move weight from the heavy side to the light side. So the pool automatically sells some of the heavy ETH and uses that to buy more of the now cheaper, lighter altcoin. It keeps doing this until the value on both sides is equal again, and the seesaw is back to being perfectly level. And this right here, this is the most crucial part of this whole thing. Look at what you're left with after this rebalancing happens. You started with a certain amount of ETH and altcoins, but now you have less of your valuable ETH and more of the altcoin that just dropped in price. The pool automatically sold your stronger asset to buy more of the weaker one. And this is exactly what impermanent loss is. It's not a bug, it's the price you pay for keeping that seesaw balanced. It's the difference in value between what you have in the pool versus what you would have had if you just held those two assets separately in your wallet. Okay, so we understand the seesaw now. Let's connect this directly back to our original question. Why has the bond ratio been falling? Remember, the bond ratio is just a measure of how much ETH your bond is worth, and we've all seen it trending downwards over time. Now you know exactly why. It's a simple chain reaction. First, the altcoins in the pools dropped in value relative to ETH. This tipped the seesaw. Second, the pool did its job and automatically sold ETH to buy those falling altcoins. The result? You are now holding less ETH in the pool than you started with. Since the bond ratio measures ETH, less ETH means a lower ratio. It's that direct. I really want to stress this point. This isn't a flaw or something that's broken in the system. Impermanent loss is a fundamental feature, the cost of providing liquidity that makes decentralized exchanges work in the first place. The seesaw must stay balanced. I know this can feel a bit abstract, so let's walk through a very simple example with some actual numbers to make it crystal clear. Okay, let's walk through this together. In that first column, that's your starting position. You put in $6,000 split perfectly. One ETH worth $3,000 and 1,000 altcoins also worth $3,000. Now, let's say the altcoin's price crashes by 50%. Look at that middle column. That's your position after the pool automatically rebalances. You now have less ETH, only 0.71, but more of the altcoin. Your total value is now $4,251. But here's the critical comparison. Look at that last column. If you had just held those assets and done nothing, you would have $4,500. That difference, that $249 between what you would have had and what you actually have, that is your impermanent loss. It's the value that was lost by the Seesaw automatically selling your ETH on the way down. Now, there is a silver lining here. It's called impermanent for a reason. If the altcoin's price recovers and goes back to where it started, that loss can actually reverse itself and disappear. It only becomes a permanent real loss if you withdraw your position while the prices are so far apart. So, now we understand this powerful downward force of the Seesaw Effect. But believe it or not, that's only half the story. You see, inside every single bond, a battle is raging. On one side, you have impermanent loss from the Seesaw Effect, constantly pushing the bond's value down. But on the other side, remember the toll booth from part 1? You have the trading fees, which are constantly pushing the value up. So the ultimate question is, which one wins? Does the income from that toll booth make up for the cost of rebalancing the Seesaw? We are going to answer that question in the final part of our series. Thanks for watching, and we'll see you in part 3 for the final answer. And as always, a reminder that cryptocurrency investments carry significant risks, including the risk of impermanent loss we discussed today. This content is for educational purposes only. It is not financial advice, and please be sure to do your own research.